Hello and welcome to the Financial Time Travelers podcast. This is episode 9, Convictions and Afflictions.
Can you believe number 9 already?
It's amazing. We're rapidly approaching 10.
Yeah.
That's a tongue twister. My goodness, this music is so loud right now.
Conflicted with your inflictions.
I'm turning it down.
All right.
No, convictions and afflictions.
But not conflictions.
Tell me what a conviction is.
So that's something that you have an adamant,
right? A very firm
opinion,
belief.
right.
Very firm belief.
Yeah.
Affliction would be pain or suffering.
Pain or suffering.
And I had
you
a
looked
great
it up.
Quote, but
you had a great quote.
Took my notes, and we're going to have to wing it. All right. So the topic of today, we wanted to discuss investing your portfolio, specifically retirement or
right.
a longer-term portfolio in the market,
right?
And what to expect during those years,
right?
Or if you're doing it short-term on your own, that the beginning stages, the beginning eras, and should not be a time where you feel like you're going to time the market. If you're putting money into the market for a longer-term build, you should anticipate that this money is going to be at work for you for a longer period of time.
Right. And the goal here is that you may win and lose some battles, but you don't want to lose the war. And the war is retiring independently wealthy and achieving your financial goals. And that's what we want to talk about, is to be able to do that. And what's neat about the stock market, Niall, is that you can buy a stock for $9, $10. You can buy a mutual fund typically for $25.
Pennies.
You can build a stock portfolio that we're going to talk about today with $100.
You could.
You could have 5 mutual funds. You can be diversified. You can be investing into emerging markets. We're going to talk about all this stuff. But what's really cool is that you can't buy 10 houses. You can buy 10 stocks or 10 mutual funds.
You could buy rental.
Well, yeah.
You can get into REITs.
Uh-huh. That's true. You could do that.
So we wanted to talk about a specific idea. We manage a lot of money outside of Financial Time Travelers podcast.com, all the cool stuff that's available there.
Right.
I mean, it's great product. You should go there, and you should go there.
Uh-huh.
What we want to talk about through our experience,
right.
working hands-on, specifically with not only wealthy people, but everyday people,
right.
In 401k plans, participants,
right.
is that when we see market volatility, people freak out.
And they don't know what to do.
And they take all their money and run. We had several meetings. I've had several calls since Brexit happened, since February 11th happened.
Which was the bottom of the market. Worst January
correct.
in the history of the Dow Jones.
And
who would have thought?
Emotion does not discriminate tax brackets.
Correct.
Right? So we've had very wealthy people sit in our conference room, and I've also had participants of 401k plans that are nearby our office come in and sit in my office and talk about how we should rebalance their portfolio.
Right.
And so we thought it was a very appropriate topic to discuss what you should expect when you put your money at play in the stock market, specifically for what your goals are. So I think it's very important to start with the end in mind, right?
Correct.
To know what your goals are with this money. What am I saving for? For most times, I've heard you say many times that there are only 2 times that you should go into cash. And what are those 2 times that you generally are? It's a rule of thumb. It's not specific individual
correct.
advice. We're not giving advice here. This is all educational based on our experience.
Right.
But what are those 2 general times that are the only times when it's appropriate
spot here.
to be in cash?
So yes, there are only 2 times. And all the other times you would be better off in another type of an investment.
Allegedly.
Allegedly, yes. And so the first incident is when you have a very short-term need. So you're going to buy a house, you're going to buy a guitar, you're going to buy something. And
very
it's
important.
Very important. Within the next month, 2 months, maybe even, depending on how important it is, maybe 6 months.
Maybe a year if you're saving for a house.
Yeah, probably a year. It would probably be as far as I would go that I would be in cash. Now, today, cash is expensive. In America, it pays you 0.
That's an oxymoron.
And with inflation, so you automatically... And we have very low inflation right now, right? So 3% inflation.
Allegedly.
So 3% inflation, and you're earning 0, and you do that, you hold that for a whole year, you've just lost 3% buying power.
Right.
But 3% of buying power versus potentially being at risk and not having the money to put down on your home, that's okay. So the one incident is where you have an important short-term need, and you don't want to take any chances. You've got the money, you've got the down payment, you have the funds to achieve that goal, whatever it is short term. You're going to now don't lose our robot.
Sorry,
there.
robot man.
And you're going to use that money. That's number one. The second, and this is a much rarer occurrence, anomalies, is when cash is the best performing asset class.
This might be an affliction,
right,
combined with a conviction.
Correct. And that has happened only a few times in my entire career, where cash was the best performing asset class that year.
Now, your entire career spans several centuries, if I'm not mistaken.
At least 3, yes.
So this is
a
good amount of solid data to pull from.
Yeah. And I look pretty good.
I appreciate that you don't hit me on camera.
300 years.
Only off camera.
Yeah. So... And in 2008, cash was the best performing asset class. Bonds were going down because we had the crisis with Lehman Brothers, and we had AIG, General Motors. And what people were looking at is, if the stock's going down, I don't want to own their bonds either. And so bonds were going down, stocks were going down. Cash, at that time, was about a 1% return. Stable value funds were about 3.5% returns. Cash was the best performing asset class, not because it made money, because everything was crashing so badly. That is a much rarer occurrence where cash is the best performing asset class. Very rarely is it. But in most cases, you are better off in other asset classes.
When the market drops, you go into cash. What are you doing?
So you don't have to go to cash.
No, let's just say you did. What have you just done with yourself?
Okay, and you're bringing up a good point, because to be right with cash, you have to make 2 correct decisions. The first decision is getting out at the right time. So if you're getting out at a low of a cycle and then it turns around on you, you're now sitting on cash and the market's now back and recovered, and you've just locked in your losses.
Boom. Locked in your losses.
Correct. And the only way to make it up is you got to get back into another investment and be right. So you have to be right twice when you're going to cash. You have to be right on your exit, which means getting out before the market collapses or before your position sells off. And then be right when you buy in. You want to buy in at a lower point where it does indeed appreciate. You have to be right twice with cash to make cash worthwhile. So that's why it's very hard for cash to be an investment asset class, because of so many ways that you cannot make money. And currently it's even more challenging because you have zero reward for owning cash. Whereas years ago in the 1990s, you were at least making 3-5%.
That's a great point. And I keep bringing it back to retirement because I feel like a lot of people...
Is that because you want to retire?
I don't know what retirement is.
Yeah, neither do I.
But I'm thinking about retirement accounts because that's where most people start, and I think that's where a lot of the money's in the market is. If you take out
$6 trillion
right
of 401k money.
Of 401k money, and I think it's more than that. We'll have to fact check that. We'll have the fact checks in the show notes.
Okay.
But there's a considerable chunk of the market. If you just look at 401ks, I think you're excluding kind of IRAs and simples and all the other retirement classes.
You didn't see the asterisk when I said that?
No.
Okay.
Well,
it kind of
allegedly.
It almost hit you in the head.
Allegedly. So
$6 trillion.
Told us allegedly.
Okay.
And I'm thinking about long term. Even if you go to cash, and I met some of these guys where they go to cash, now they want to rebalance in. You can't even turn over your portfolio every 30 days. And most of these 401k plans,
they have limitations.
Right. You're actively trading. You're trading too much. They don't like it. They'll hit you with a fee.
Or they'll knock on your door at night. They'll knock on your door at night.
That allegedly.
Yeah, allegedly.
That doesn't happen. But if you want to rebalance it, your timing in a 401k will have to be even more amazing.
And it's difficult because you don't have the quickness of your trading.
Right.
At best, you have a one-day turnaround at best. And that's if you're paying attention.
And you can chase for the next year and a half. Rebalancing in your portfolio.
And chasing the market. That's
chasing the market.
So frustrating.
It's hard. A lot of people in 401ks think they just get into cash and it's easy just to rebalance right to where they were. It's not that simple.
Yes.
Which leads us to our overarching theme of this segment, which is when you put money into the stock market, you should, at least a general rule of thumb, and we read an article that was through Lifehacker, one of their Gawker media that no longer exists. But a general rule of thumb that a lot of experts say, which we want to review, is that when you put money into the stock market or bond market, really into any open market activity, you should have the mindset that this money is going to be at work for 5 years.
Right.
If you need it in a shorter time, then it probably isn't the most appropriate vehicle for you, because the market does go through dips. Volatility does happen on a both positive and negative indicator, on a positive and negative rolling momentum. And so for you to be able to really take away the rewards that you need when you're thinking about a long term, especially if you're investing in a mutual fund or an index fund, which is pooled with many other investment vehicles inside of them.
Yes.
Having that longer term mentality is critical for you to actually take away the full benefit. Right?
Yep. And part of the stock market, we get into this in our Guide to Success series for members, but we talk about macro cycles that have been in place going back to 1836. And there are definitely better times to where the chances of you making money in market conditions in the environment is much more favorable. This is not one of them. Right. When we were having Christmas and enjoying the holidays with everybody else in America, I wasn't reading reports from analysts saying, watch out, January is probably going to be the worst month in the history of the Dow Jones going back to the 1800s. No one was looking at that. It was a complete blindsiding impact. So how do you manage money when those kind of things can take place? By February 11th, if you were invested in just large cap S&P 500, you would have been down 9 to 10%.
Right.
There are many stocks like LinkedIn and others that didn't hit their numbers, and they dropped 27% in one day. You went to work, you came home, you have 27% less of your investment. So asset allocation and having a conviction that these monies are at least 5 years, and now we're going to talk about what you do during those 5 years, but you need to be able to look at it as a longer term. Now, there are market conditions, environments like the 1990s where day trading was very rewarding. I remember reading articles in the Wall Street Journal of doctors saying they're quitting their practice because they're making too much money in their stock portfolios. They did quit, and then came 2000 and they realized they're idiots. They have no idea what they were doing. Better lucky than good.
Did they do any of their continuing ed?
Right. Hopefully. But so there are rolling averages and rolling periods of time that you are better off. And so in building wealth, as I said earlier, it's winning the war, but being willing to lose some battles. And some of those battles are you have a much more diversified portfolio, which we'll talk about. It's spread out among a number of asset classes, and your portfolio is consistently making reasonable returns. High single digits would be good in this today's market. Right. But there are times that you'll read that the S&P is doing better than you are. Now, the S&P is 500 stocks. There's no diversification of bonds and cash and international. It's 500 U.S. large company stocks. And there'll be times that you'll trail that index. But then there'll be other times that you'll be beating the index. So the battles are not day-to-day outperforming the S&P. The war is getting 5-10 years down the road and being worth more and having sustainable, predictable wealth.
And that's the point we really wanted to hit home. Absolutely, to be able to build wealth, you need to have that thick skin, really.
Correct.
To be able to go through these ups and downs and be able to manage them emotionally and understand that that's something that the market goes through. It doesn't have to do with you. You need to weather the storm. It will come back. I'm looking at a chart of the S&P going back to 1920.
Okay.
And it's just almost a parabolic curve, you know, from left to right. And so if you hold long enough, basically what the market is showing you is that there's never been a time in American history where the stock market has collapsed or a whole industry or a sector has collapsed. Yes, particular stocks have collapsed, gone bankrupt, and gone out of business.
Kodak,
obviously, we saw this happen well, Kodak got bought out in a lot of different ways.
Right.
But let's say like a Lehman Brothers or something like that. There has been times where companies go bankrupt, they leave. But the overall index, the overall sector,
which is a diversified basket collection,
always recovers.
Correct.
Every single time.
Yep. Now there are, with that, I'll be the devil's advocate here.
Do it.
I happen to have some information here.
Uh-oh.
That 10-year periods of time,
some affliction,
there have been very good returns. And so 1918 to 1928, the average annual return was 19.5% a year.
Wow.
Now, in the rule of 72, if you divide, let's say, 20% into 72, That's about 3.6 times. So every 3.6 years,
doubling.
You're doubled your money. So in 10 years, you've doubled your money 3 times.
Just by owning an index fund that doesn't exist
right.
yet.
Yeah. 1948 and 1949, those 10-year following 10-year periods, 18.5% in 1987 to 1997, 1988 to 1998. During those 10-year periods, 18% returns. That is making money.
Right.
However, conversely, there are 10-year periods of time where you virtually made nothing.
Nothing.
You started out at the beginning of the 10 years, and at the end of the 10 years, you had a 1% return, a 0.4% return.
Right.
1966 to 1982, that's a 20-year period of time that the stock, a 16-year period of time that you would have a 0 return on your money. So there isn't blind hold it, wake up 10 years from now, voila, you've made 12% a year. You have to manage the money and pay attention to it, but if you're in it for 1 year, your odds are now reduced dramatically that you're going to walk away with more of your money.
Right. So the majority of your money is sitting in an index fund, a bond index.
Diversified.
Correct.
Balanced fund, ideal.
Large cap, mid cap, small cap, bonds.
You can do an a la carte. You can do an a la carte now. You can have so much in S&P 500, so much in the S&P 400. You could do that.
That's what I'm getting
But
at.
I'll tell you, you know what's an easier way to do that?
Tell me.
Is you buy a balance fund. And there's some very good balance funds like Vanguard or target date funds. That is, and you look at the prospectus and the brochures, 5% large cap, 10% small cap, so much big companies,
just know
small
what you're
companies,
getting into.
International, bonds, cash, real estate, financials. It's a fully diversified basket. You only buy one fund, and you've got the whole thing.
Right.
Way easier than a la carte building it yourself.
It's definitely easier.
Correct.
I don't think it's for everybody.
But
that's why they were created, though, is because they're like, why are we spreading all this out when we can take all these funds and put it into one umbrella in charge of expense ratio that's very competitive. So
Vanguard's expense ratio is almost 0.1%, 1/10 of 1%.
Expense rate. That's a whole nother podcast that we should do, because
we should
people
do that.
complain about $1 when they can make $10.
Right.
Where's
but
the
a la carte,
outrage?
you do have ticket charges. You have more funds you have to pay attention to. Is it the best large cap growth fund? Should you have been better off in an S&P 500 index fund?
Right.
So there is a lot more moving parts as you start going a la carte.
Either way, the argument is to be diversified.
Yes.
In these.
We do agree on
areas.
that. We do.
Absolutely.
Correct.
Well, I don't think we disagree on anything. But there is a specific section which takes more detail for you to look at and to make sure that you're looking under the hood a lot more frequently.
Well, what do you mean by that, looking under the hood?
A lot more frequently. You want to do more checkups on the specific area of investments that you hold in your diversification pie.
Okay.
Can I give you any more hints?
Yeah. Go ahead.
Would you take a alternative investments for $200?
Well, so now we're leaving the foundation. So you've built your foundation.
Boom.
You've selected a balanced fund, whether it's Vanguard or you did it on a la carte so much, and you have 10, 15 funds.
Robo-advisor, whatever you're comfortable with.
So you've got your base. Now that base should be where the bulk of your monthly savings is going into. It's where the bulk of your investments. It's the bulk of where you're hanging your hat that 10 years from now you're going to be worth more with this basket.
Because of this.
Right. So there'll be times that small companies are going down while large companies are going up. There'll be times where bonds are going up when stocks are going down. There'll be times that international, the EFA or the MSCI is going down while the U.S. index is going up. So your diversification, everything is working together. One side note, by the way, Niall, and this is interesting because it's against what most people would think that you'd want to achieve. But what you don't want is a diversified portfolio that's all correlating together. And what I mean by this is that if everything's going up, now that's exciting when you look at your 401k, when you look at your mutual funds and your statement, and everything is positive. That's very exciting. But you better be worried, because if everything goes up together, everything will go down together. So ideally,
what goes up must come down.
What you want to look at is your overall net return. So if your net return is achieving your objectives, 5, 6, 10% a year, And inside your portfolio, you have some things going down, some things that haven't moved, and some things that are going up, but your net returns being achieved. That's an ideal scenario, because now reverse that a year from now. For example, last year, utilities was one of the best performing categories. This year, one of the worst performing categories. Gold, oil last year, worst performing categories. This year, best performing categories. Now, there is a point in time that if you have a category like gold and you're down 30, 40%, in my opinion, once you are down 10 to 12%, you're starting to trim that position. And there's a couple of ways, and we'll talk about that.
Loss tolerance.
Loss tolerance. What is your tolerance for losing?
Right. Very straightforward.
Or, as the professionals call it, loss tolerances. But simply, before you buy something, you make a note to yourself or make a note in the folder. We've talked about having your folder, looking at, okay, I'm buying this mutual fund, I'm buying this stock. My tolerance on the downside is this much. And then you hold to it. And so anyway, so in looking at...
Which can be tough, because if you sell out at the bottom and then it rebounds right back up.
Right. But if it's a good investment on the rebound, then you can buy it again. No one's holding you from not buying it. But in 401ks, you mentioned it correctly, that you have to be careful how much buying and selling you're doing.
We're restricted on time, or I would go in right now.
Yeah. However, we did talk about, as we get into alternative investments, and this is where it's a complement to your core. So your core is anywhere from 60 to 80% of your money is in this core basket of diversified asset allocation
according
funds.
To your risk or your age, whatever.
So balance funds, target date funds, and we have a great segment on target date funds. But so that's your core. Now, outside of that core is where it can get a little more fun and where you're going to take a little more strategic approach to it. Absolutely.
This is definitely the more attractive style of investments that gets the headlines.
Correct. Exactly. And this is what you talk about at your cocktail parties and your Saturday evening get-togethers.
You don't say, yo, how's your large cap index fund doing?
Yeah. And you know what's funny? You know what's funny, Niall, is that
I own a large basket of goods.
Yeah. When I talk to people and they, of course, learn about what we do, and they say, oh, I bought Facebook, or I bought this, and I'm up 25, 40% and 70%, and
$4,000,
and I'm listening to them, and eventually I'll come around and ask them, by the way, how much did you put into that Facebook? Oh, well, I own 10 shares. But I'll tell you, they're very excited about those 10 shares that they're up 30%.
Oh yeah,
and that's okay. That's
what it's there for.
Yes, exactly. And sometimes you can hit some nice home runs, but the 5 to 20% of your money can be in this alternative category of assets that are specific stocks that you read about, or you feel that they're good investments.
That's one.
It can be specialty mutual funds.
There you go.
And you like specialty funds
outlined by the sector, especially.
What are some of them you like?
Most 401k plans don't have specialty funds.
No, that's unfortunate. But what are some of the ones that you like?
Well, there's 10 S&P categories right now. Soon to be 11.
11.
That's a good note.
And you wrote about this.
We might be dating this podcast by saying this, but real estate. Yeah. Come September 1st, will have its own category, thanks to the GICs.
Pulled out of the financial category.
Exactly. So right now you got technology, consumer discretionary, materials, healthcare, utilities, consumer staples. Telecom, industrials, financials, energy.
Right.
So right now everybody's talking about financials. I see it coming over the wire every day. There's like a positive story on which financial bank to buy and reasons why. We have rates coming out that's supposed to be healthy for them. What are their everybody's looking at balance sheets right now, net income statements.
But they've been waiting for rates to go up for a long time, and
financials got hammered.
Have been tough.
And so it's kind of like the obvious play. Okay, if financials have been hammered, they're bound to rebound with interest rates coming up. I mean, they've been inflated by the central bank so dramatically. I don't know if anybody can get a solid read on financials right now.
But you bring up a good point, though. And I want to go back in case the listeners didn't catch your point. And that is that sometimes a very good strategy, now we're talking 5 to 20% of your portfolio. So this is your fund money. This is the money that, if you're right, can have a little impact. It can move the dial a little bit.
Right.
But if you're dead wrong, you still got the 80%, you're going to win the war. And this is important. You're going to win the war. But sometimes it's fun to win some nice little battles.
Right.
And so one of the ways, and this is what you said, and I like this, is that you look at last year's worst performing. And so you said that financials have been hit hard. The longer a particular asset class is in the dumper, sometimes the better the return is, and the snapback can be big. 3 years of bad returns can be all made up in 9 months, and that's a huge fun ride when that happens. And so you can buy, for example, we've already said that utilities and gold and energy and oil were the worst utilities were best performing, but gold and oil were the worst performing sectors last year. This year, they bounced back very strong. Utilities was the best performing, and this year, one of the worst performing. So you can have some fun with this 5 to 20% of your alternative investment to complement your core, and just simply pick some of the worst performing last year and add them to your portfolio this year.
In our overall category, it's not a bad thing. I think people think that way, contrarian with individual.
I don't know if I'd do this with stocks.
Individual stocks,
I don't
a different
think
story,
so.
Right? Because that can have a lot to do with management.
They can be in the dumper for a long time.
Yeah, it could have to do with their staff, of how they're managing their money, what their bottom line is, what their own net income, all the technicals and the fundamentals of the company. But when you look at specialties, it's not a bad time to look at an entire sector and see how it's performing and whether it's poised for a rebound. I'm not convicted if financials are there yet.
No,
healthcare took a dump, and I think it was simply because
biotech pulled healthcare down
as an industry inside of the sector, but the sector was down last year a good amount.
Yeah. And biotech in particular.
Absolutely.
And biomedical.
And bio took it down, but I think that had to do with being too good for too long.
Yeah.
So it's kind of the opposite story.
Almost 20% returns
you're looking
by
at
some funds.
The places to buy that have been bad for too long, and then you're looking for the places to sell that have been too good for too long.
Correct.
And that's exactly what happened with healthcare. It got dumped in October, right as the market slid, and it was like, I need my alpha, I need my positive above the allocated measure amount that I was supposed to get. I'm going to take that off the table because I'm taking losses in the other side of my pie.
Well, also, August last year was a very big sell-off month. It was hard. The market was down almost 10%.
Right.
And so the premium stocks, those that were trading well above their normal historic averages, they got hit the hardest. And biotech, as you mentioned, and healthcare was a very strong asset class for the previous 3-4 years. And so it was prime. It was a target for investors to start selling it off. But what is important and that we want to emphasize here is you want to build wealth every year. You want to be seeing your accounts growing every year.
Continually contribute.
Correct.
And appreciate.
And the key to that is you have to have realistic expectations. You can't be trying to make 10-15% in a period of time that since January of last year of 2015, the S&P is barely above 4%. Yeah. So there are time periods that you'll make more money, and there'll be time periods where you'll make less money. But the key is to not lose money, and that's the key.
I had a hard time taking my glasses off right there. Absolutely.
Yeah.
Not losing money during these times. That was a big theme for going into this year with all the volatility. Make sure you don't lose money.
Correct.
But also make sure the market doesn't run away from you at the same time.
Right.
I think the biggest, in my experience with specialty funds, when people pay too much attention to them, they get romantic about it.
Okay.
And then they let
What do you mean by that, romantic?
They like it too much.
Okay.
It's their favorite piece of the pie.
Okay.
So what do they want to do? They want to make more pieces of the pie, that same slice. So we saw that with healthcare.
Correct.
And there's momentum and inefficiencies where the undereducated start just following the trends, and they start loading up on what's been working for them, but they don't understand that the smart guys are the other side of the desk. When you're buying, they're selling.
Correct.
And so that's what I've seen to drag down everything you earned when you're holding on too long. You start expanding that piece of the pie too big. For instance, we were just talking about healthcare, same exact thing, technology.
Right.
And you start letting that take up 30, 40, 50, 60% of the pie. One of the big mutual fund companies and allocation funds, conservative, moderate, growth allocation funds. Their conservative allocation fund that I uncovered last year was mostly energy positions, which had been killed. And so I'm like, why is our conservative fund so drastically behind the 60-30-10 benchmark?
Did you ever find out? Did you talk to them? Ask why they have so much?
And they were convicted that energy was going to make a play, and it was along with their investment policy statement. And I moved a bunch of money out of it, or recommended people.
So I know the fund you're talking about, and what they did is the classic mistake is they doubled down.
Yeah, they did.
And this was a well-respected balanced fund.
Yeah, why was there so much beta?
Yes.
In a conservative fund?
They were disenfranchising their customer base because their customers who largely don't pay attention to this stuff, don't look under the hood, as you said, and figure out what exactly does this mutual fund own. And unbeknownst to them, they were increasing their allocation to a losing position with a conviction that it was going to recover. And here we are a year and a half later, and oil prices, the Texas Intermediate crude is today at $44 a barrel. So they were dead wrong. And good thing we moved their money.
Oil is everywhere, and that's a whole nother topic on
that's
oil.
Another one. Let's
But the majority of what we're saying is that you want to have a big piece of the pie that you have a longer term vision for. That will always be there. So don't think that this is going to be a get-rich-quick scheme. That's not what's happening with the stock market when you're investing in pooled assets that take up either an index or a mutual fund, like you're saying.
Correct.
And then you have something that's a smaller slice that you can play with a little bit more, that you want to watch closer.
Yep.
Hopefully, you can take this down to a financial advisor who's a certified financial planner, or someone who's giving independent advice that's not commission-based.
Right.
To
you don't
take
want
a look
that commission.
At you take a look at what you have put together and give you approval for whatever their flat fee is.
And they can be a nice sounding board and add some nice input to what you're doing.
Right.
But the key is that in today's economy, and we talk about this in our Guide to Success series, that there are macro cycles. They're about 17 years, and it's 17 years of very difficult time to making money. And then there's 17 years of you can be shooting fish in a barrel. It's a very good time. And we're in one of those cycles that it's the 17 years of hard times, and it's difficult to make money.
Right.
And so the average return of the S&P 500 since 2000, here we are in 2016, since 2000 is a little over 2.5%.
Could we do a podcast on the positions we are very convicted about and the ones that we are very afflicted about?
As of now, or
yeah.
Okay.
I think
there's some very exciting
We're actively
areas.
managing money for people. I think it'd be cool to kind of pull back the curtain and say, this is what we feel convicted on.
This is what we like, yeah.
So
you know what's funny? Just a little side note. I started in this business in San Francisco, and what really amazed me, Niall, is that you're in this room of investment advisors, back then stockbrokers, right? They're not stockbrokers anymore, and you make money on tickets. So you had your
more like stock salesmen.
You had your tickets, and so you're dialing for dollars. You're trying to, you have this conviction on this stock, and that's going to be what you're going to work with today. You're going to be making calls and try and sell shares of that stock. So what I always thought was really funny. So let's say you're buying whatever stock it is, and there's millions of shares of that stock traded. The only way my clients will make money is if more people want to buy that stock especially after they've bought it. And because of the increase in demand, price does what?
Goes up.
Goes up, right? So the concept is very simple. Buy before more people want it. And then as more people want it, the stock price goes up.
And you happen to be sitting in a room of 500 brokers.
Exactly. So this is where it gets funny. So come break time, you go.
By funny, you mean corrupt.
Yeah. You go, hey Niall, what's your favorite stock? They wouldn't tell me. I go, why aren't you telling me? Well, it's just kind of, I did my research, and, do your own research, find your own. Don't you want me to know what you're buying for your clients so that I can tell my clients what? Of course there is rules on that. Now you're bumping the market. But the point being is that there would be like this close to the chest conversations that you wouldn't tell the next broker what you're buying and selling because you did your research. This is your conviction. You want your own conviction. Do your own research, right? And yet the only way my clients will make money, I guess, is the broker in the other company and that they're buying it. But they wouldn't tell you. Even today, if we go to conferences all the time and you say, what are some of the mutual funds you like? I like this, the big ones.
And these are guys who aren't managing very much money at all, which is funny. It's not going to move the market whatsoever.
Right. And what do you care?
I understand it if maybe like a huge institution is going to make a big change or
But
rebound.
the sense of proprietary in a publicly traded security,
right.
I thought it was very comical. But anyway, just market. That's then. Well, that's not now.
I hope everybody's pulled some value out of this podcast. You can share it. You can go on iTunes, Stitcher, SoundCloud. We're available there to be able to listen. We're also on YouTube now. That's what these visuals are for. Shout out to you. Shout out to you. And maybe the GoPro is in here.
Yeah.
So you can go to YouTube as well. Feel free to share it. Spread the message that we are here to help you achieve your goals at a faster rate. We're also on Twitter, Facebook, Instagram, all the major handles. Anton's on LinkedIn. I'm not, because I'm not very professional, apparently. But we're out here.
You're on Snapchat.
We are out here, and we're on financialtimetraveler.com. We have some great things coming up. We have a members area that's going to be flooded with top-notch information for our members only. And then, of course, we've got the free stuff coming all the time, which is a blog,
and we're going to start adding
audio,
some guests to our programs. We're already starting to make very cool guests, and we've got some pretty exciting situations coming up that are going to
absolutely, and as well as you might hear us on your other favorite podcasts. You never know.
Yeah.
So that'll be coming. So we appreciate everybody tuning in. Share. Go to the website. Otherwise, we'll see you on episode 10. Double digits.
Yeah, we hit it. Double digits.
It's a high.
All right. Yeah. There you go.
Right.